Good morning, everyone, and welcome to the information session on BCFSA's approach to natural catastrophe and climate-related risks. My name is Christina Panaggio, and I'm one of the stakeholder engagement specialists here at BCFSA. I'll get us started and situated with some pointers about the format of the Zoom webinar session. Today's webinar is scheduled for 90 minutes. Your microphones have been muted, and you're in listen-only mode. Similarly, you will not have your camera on, your video is off. At the bottom of your screen, you will see two icons, the chat function. You're welcome to use the chat function to send a note to the panelists on today's call. There's also the Q&A function. This is where you can submit your questions. If possible, please don't use the chat box for this. If you find the Q&A, that's the place to go. And as you're in listen-only mode, your questions will need to be typed in the Q&A. Another note about the Q&A, reminder that there will be a time at the end of the presentation for the question and answer period. You can select to submit questions anonymously, and we will try to address them. If we write the answers, written answers will be posted for everyone to view. Finally, we will be recording today's session, and it will be available on our website as soon as possible. The PowerPoint will also be available. Next slide. Before we begin today, I would like to acknowledge that we are gathered here on the traditional territory of the Musqueam, Squamish, and Tsleil-Waututh Nations people, who have been stewards of this land, which we all call home for many generations. While we meet today on a virtual platform, many of us are in different locations throughout the province, and I would like to encourage you to take a moment to reflect and acknowledge the traditional territory you may be calling in from. Next slide. Our first speaker today will be Rob O'Brien, our Director of Regulatory Initiatives. We also have Lucas Neufeld, our Senior Policy Analyst, and Francesca Nigman, our Director of Risk Surveillance and Analytics. In addition, on this call, we have Emily Shaw, our Manager of Real Estate Policy, and Damara Kiseniak, Senior Risk Analyst of Pensions. I'd like to pass on to Rob O'Brien to start the presentation.
Thank you, Christina. Now let's have a look at the agenda for this morning's meeting. We're going to start with an introduction covering BCFSA's mandate and regulatory scope, including the launch of BCFSA's discussion paper on natural catastrophes and climate-related risks, or NCCR for short. We'll spend some time explaining why BCFSA has identified NCCR as a material risk and discuss the scope of BCFSA's role with respect to NCCR. Next, we feel it's important to take some time to provide an assessment of climate and earthquake-related risks. We will then go into detail on BCFSA's proposed approach. We will then revisit the consultation activities and opportunities to provide feedback, and then close with questions. Next slide, please. In late 2021, BCFSA's policy team established a natural catastrophe and climate-related risk working group. The events of that year, including floods, wildfires, and the heat wave, really put into focus the need for BCFSA to develop a coordinated, consistent, and integrated approach to climate risk that reflects each of the segments that we regulate. Heat domes, forest fires, atmospheric rivers, and flooding. The realities of climate change are here. Adapting and becoming more resilient to the risks posed by climate change and natural catastrophes will require innovation of unprecedented scale and speed. While BCFSA is becoming increasingly concerned of the risk posed from climate change to the financial system and consumers, we have always been concerned with the risk posed from a large earthquake. We believe that both earthquake and climate change pose material and systemic risk to the Canadian financial system. We are also very concerned with the extent to which consumers may be unaware of their risk exposure and lack adequate financial protection against natural catastrophes. Some natural catastrophes like floods and wildfires are increasing in frequency, intensity, and volatility. I'll start off with an overview of BCFSA as an integrated regulator, which oversees credit unions, real estate services, and development marketing, mortgage brokers, insurance, trusts, and pensions. Next slide, please. In 2019 and 2021, the government of British Columbia brought into force changes to create BCFSA, the BC Financial Services Authority, a modern, effective, and efficient regulator to oversee 10 statutes and the financial services sector in BC. We have oversight over the life cycle of some of the most important transactions a British Columbian can have in their lifetime, from securing a mortgage, buying and insuring their home, building their savings, and trusting their pensions will be there in retirement. By bringing together oversight of the majority of the financial services sector into one regulator, BCFSA can connect issues and risks across different verticals to see a more comprehensive picture. And that helps us respond as a proactive and risk-based regulator. BCFSA's role as a regulator is to conduct ongoing surveillance of the financial services sector to identify material risks and potential consumer protection issues, and to intervene as necessary with regulatory expectations to ensure safety and soundness and protect consumers. Natural catastrophes and climate-related risks were identified as a regulatory priority by BCFSA in its 2023-2024 regulatory roadmap. The discussion paper outlines how natural catastrophes and climate-related risks are material and why a comprehensive approach across the financial services sector is needed. The goal that we share with everyone here today is to promote confidence of the public in the financial services sector in every aspect of those transactions. More about the consultation and the discussion paper on the next slide. The discussion paper on natural catastrophes and climate risk was released on July 19th. We initiated the consultation to collect feedback from our regulated segments on our proposed approach to managing these risks. In part 5 of the paper, there are a set of general questions, as well as segment-specific questions to guide a conversation. The discussion and the questions we have posed aim to encourage our various stakeholders to share their thoughts, perspectives, and ultimately fostering a conversation. The discussion paper takes into account the outsized impact that real estate has on BC's economy and proposes an approach for our regulated segments that provide financial services throughout the life cycle of real estate transactions. As an introduction to the release of the discussion paper in June, at BCFSA's sector-wide forum, one of the panels we hosted was a climate panel to specifically look at the potential impacts of climate change on BC's financial services sector and consumers, and the regulator's role in ensuring climate and natural catastrophe risk are well managed. The panel discussed the impact that climate change is having on real estate and its associated value chain and climate scores for real estate. We invited 2 experts to speak and to build people's understanding of and conceptualize the resources that are available and those that could be made available for the financial services sector and consumers to better understand natural catastrophe and climate-related risks. And then think about how these resources fit in with BCFSA's approach to identify, measure, and where possible, manage the risk from natural hazards. We released this video as part of the launch of the consultation as a resource for our regulated entities and individuals. In this brief video, about 3 minutes long, features BCFSA's Vice President of Policy and Stakeholder Engagement, Saskia Tolsma, myself, along with climate change experts and researchers, including panelists from BCFSA's forum, Catherine Bacos from the Intact Center on Climate Adaptation, and Chris Chopik. Chris Chopik is a realtor with Sotheby's International Realty Canada Brokerage, who provides an overview of key concepts outlined in the paper. Helena, if you could go ahead and please play the video.
The first part of this discussion paper is BCFSA setting out what we think our appropriate role here is. It's really about risk management for the sector. So we're going to lay that out in a discussion paper. Adapting to climate change in terms of financial services risk. What does this mean for your segment, and what do we need to be thinking about in terms of our guidance? It's not going to be your typical discussion paper where we throw it over the fence and ask sector participants to get back to us in 60 days. It's going to be longer, and having some discussions with the different segments.
So the purpose of the consultation is really to allow people to provide their feedback, their perspectives, and to really ensure that this is the start of a conversation with BCFSA, both for those that we regulate, as well as those who live here in our province.
According to the Intergovernmental Panel on Climate Change, the IPCC, who's the global authority on all things climate change is real, it's happening, and it will continue to happen. We can slow down the rate of change, but we cannot reverse it, at least not with the technology we currently have.
Canadians are reading the news and seeing the frequency and severity of wildfires across the regions of Canada, where various communities are really being hit hard, and that is raising the awareness. I think there's a real gap, though, in what we can do to protect ourselves.
Starting in 2024, we are going to look at what actions we need to take to better fulfill our mandate, which is safety and soundness and consumer protection. We are concerned about the number of British Columbians that will be impacted by changes to our climate, and we want to ensure that those consumers are better protected.
The best witness of the physical costs of climate change is the property and casualty, the P&C insurance sector. So a CAT loss is any event such as a flood, wildfire, hailstorm, windstorm that triggers $25 million or more of insured losses. Between 1983 to 2008, losses range from approximately $250 to $450 million per year. From 2009 onward, losses now average $2 billion, with a B, dollars a year.
First, gather the information that's available and assemble it in an understandable way, and then make it available to every actor in the whole supply chain, so that if a home inspector is doing an assessment of property, they can observe the flood or fire risk at the site level. Ultimately, what we'd like to do is be able to have a credit score or a walk score for climate risk. So the idea would be you put an address in and you get, it's a high risk of wildfire, it's a low risk of flooding.
This conversation is really informed by discussions with experts. It's informed with discussions with other regulators from different provinces, our federal counterparts. And then it's a conversation with industry sector leaders to understand, how does this impact their business? How is this going to impact their industry? And how is this going to impact their consumers? So we're trying to have that conversation to really understand, how can we manage this adaptation we as a financial services sector are all going to have to go through together?
It's a community scale response. You can't just put a seawall in front of your house and expect the water to go around. You need a community scale cohesive response in the marketplace in order to keep up with the risk that's growing to protect ourselves.
Okay, thank you, Helena. So as mentioned earlier, the discussion paper, which was released in July for consultation, is currently open for comments and feedback until November 30th. In addition to the written feedback, we are engaging with industry associations, government, and other regulators to discuss our approach and engage on specific actions related to different segments. We are continually working to ensure that our approach is consistent with other regulators where appropriate, and pushing for greater coordination across regulators and government. Next slide, please. For many years, regulators have been monitoring the potential impacts that climate change could have on the financial sector. Earthquake or seismic risk has always been a concern for BCFSA. At a certain point, the risk posed by NCCR have become more acute, requiring BCFSA to take action to ensure that financial service providers are considering this risk. Next slide, please. Many of you may have seen this chart before, and in fact, this is what Catherine Backhouse was referring to in her comments in the video. It depicts insured losses in Canada over the past roughly 40 years. The general trend being seen globally, nationally, and here in British Columbia is of more extreme weather, extreme heat, drought, wildfires, floods, and other violent storms resulting in increased damages or losses. While this trend overall is increasing, there has been an acceleration in recent years, with insured losses consistently surpassing the $2 billion annual threshold, and it is looking unlikely that insured losses will retreat below this mark again. This chart shows insured losses, and the note at the top of the slide indicates for each dollar of insured losses, there are $3 to $4 in uninsured losses that are borne either by property owners, businesses, or government. We also know that natural catastrophes have a large impact to people's physical and mental health. Next slide, please. As I mentioned up front, British Columbia has been disproportionately impacted by climate change disasters, from unprecedented forest fire seasons, including the historic fire in Lytton in 2021 and this past summer, where the residents of several communities had to evacuate their homes and have lost homes. Wildfires tend to exacerbate the effects of heavy rainfall, and we again saw the atmospheric rivers in 2021 inflict severe damages on our provincial highway system, several communities throughout the province, as well as significant tracts of agricultural land in the province. At the same time, parts of our province are significantly exposed to the threat of a mega earthquake, or an earthquake whose epicenter is within close proximity to heavily populated areas of the province. Such an earthquake would result in damages far greater than any climate-related physical event that we've experienced. Next slide. As BCFSA develops its approach, we need to be consistent with the mandate we have been given by government. And while this may seem like an obvious statement to make, our mandate is not always well understood by all. BCFSA's mission is to promote confidence in British Columbia's financial services sector and protect the public by providing risk-based and proportional regulation. A competitive and resilient financial services sector is critical to support a healthy and sustainable economy. Our strategic imperatives include ensuring the safety and soundness of the financial sector and consumer protection. For those of you that may not be familiar with the concept, safety and soundness refers to regulated entities such as financial institutions and pension plans, complying with regulation and standards to effectively manage risks. And for good reason, the financial services sector is heavily regulated. Throughout ongoing supervision of financial institutions and pension plans, BCFSA can provide the public with confidence that the financial services providers will be able to deliver products and services when customers need them. We need financial services providers to be resilient in the face of risks posed by NCCR. While consumer protection has its own definitions and approaches, depending on the different segments that we oversee, BCFSA ensures that customers' interests are protected and promoted by those financial services providers. And as a forward-looking regulator, we are continually monitoring and evaluating potential risks to the financial services sector. Next slide. The approach that we have laid out in our discussion paper is outlined on this slide. We believe that there is a demonstrated need for regulatory intervention. Our proposed approach is risk-based and integrated across the segments that we regulate to increase the resiliency of financial services providers and consumers. There are two pillars that support BCFSA's strategic imperatives of safety and soundness and consumer protection. Pillar 1, ensuring financial services providers identify, measure, and manage NCCR. And Pillar 2, ensuring that our that financial service providers disclose NCCR data and information. And we will go into a much greater detail later in the presentation. Next slide. One of the concepts in our paper is that NCCR demands a whole of society approach. And by that, we mean that our work is a small but significant part of a much greater effort to address the causes of climate change, mitigate risk drivers, and build resilience. This brings us to how we've scoped out our role. Next slide. We recognize that there are other players, including government and private sector actors, that play a very important role in how financial services providers can identify, measure, manage, and disclose the risks from natural disasters like wildfires, floods, and earthquakes. For example, the Federal Task Force on Flood and Relocation has recently confirmed the need for updated high-quality flood maps to be developed to better identify areas at risk from flooding. Provincial and federal governments have committed funding to complete this work. BCFSA does not provide any funding after disasters. This falls within the mandate of provincial and federal disaster financing agreements. It is a widely held view by the scientific community that humans need to limit our GHG emissions and transition to a low emission economy in order to avoid potentially catastrophic warming scenarios. And for the most part, it is going to be government policies that affect the most change to behavior and risk. For example, it would be government that could place a price on carbon and enforce compliance with emission targets. In the approach that we have proposed, there are some that may say we aren't going far enough to address the causes of climate change, for example. Some would like us to be more prescriptive toward what a financial institution should and shouldn't invest in, for example. However, we believe that it is government that should set the policy direction, and we should continue to fulfill our mandate of ensuring safety and soundness and consumer protection. We can and will use our position as a regulator with intimate knowledge of the financial services sector and the risk posed by NCCR in different ways. We can provide strategic advice to different levels of government that informs policy development, and we can continue to work with other Canadian regulators through National Regulatory Association. So at this point, I'm going to turn it over to Franziska Niesman now to discuss risk assessment.
Thank you, Rob. So when we talk about climate and earthquake-related risk, we have to also find a common language and common definitions. And in the next couple of slides, I want to establish these common definitions and then link it to impact to the financial services sectors that we regulate. If we can move to the next slide, please. And here we really follow what has been established over the last couple of years within the financial services sector, the financial regulatory environment, the global financial services regulators, and also central banks. So climate risk is really at the forefront and gets a lot of attention by financial regulators and central banks around the world. So first, I want to introduce the concept of physical risk. So physical risks arise from exposure to severe weather events, such as floods, wildfires that Rob mentioned in his introduction, storm surges, heat waves, and landslides, and we refer to them as acute risks. And then there, in addition, there is the longer-term gradual shifts in climate conditions, such as changes in precipitation patterns and rising sea level. We refer to those risks as chronic. For completeness, I want to mention there's indirect effects of climate change, such as the loss of ecosystem services, for instance, water shortages, desertification, impacts on marine ecology, etc. And as Rob highlighted in his introduction, we have deviated so that the first three bullets explain what is generally considered as physical risk but given our geography in British Columbia and the importance of earthquakes and the potential impact a large-scale earthquake could have throughout our economy, potential not only provincial but potentially on a national level, and its potential disruption, then also damages to physical assets. We have included earthquake risk and adapted physical risk to include these because they can also be treated fairly similarly if we compare it, for instance, to flood events. Those will lead to damages of physical assets, and hence we have included earthquakes. And I want to emphasize for us, a focus is really on wildfires, floods, and earthquakes for the BC context. Next slide, please. So why are physical risks at the heart and really important if we discuss climate risk? Because they arise from the potential damages to physical assets from these severe weather events. We mentioned floods and wildfires and earthquake events, and they become financial risks. They lead to losses. And the impact, we see that in the financial services sector, is if a flood event happens, for instance, we expect damages to properties, and through that, property insurance claims that will directly impact insurers. And on a broader scale, a reduction in the value of investments in real estate and infrastructure that impact pension funds, investments, insurers, investment portfolios. In addition, there is expected to be reduced value of real estate collateral, directly impacting credit union lending portfolios that are largely secured by real estate. And then there is also impacted business activity, potential impacts to business activities, and that really impacts all businesses, all financial services providers. And if we focus on the impact to consumers, reduced value of real estate impacts property owners directly. Impacted business activity affects all businesses, but also employees that are employed by those businesses. And damages to structures content not only impact property owners, but also renters. So we have established physical risks have physical risks, and physical risk events have the potential to lead to financial losses, to financial impact. And I want to highlight the time horizon for these risks to manifest is immediate. What Rob alluded to also is event severity and frequency has increased in recent years. And one concern we have as regulators is really the exposure that is increasing. The built environment, people exposed to potential natural hazard events is increasing over time. We see more people through urban densification, more buildings, and also more expensive buildings, leading, once an event happens, leading to potentially higher financial impact. And if we can move to the next slide, please. So as I alluded to, that physical risk exposures really arise also through potential impact to physical assets. And at the heart of our regulated sectors is real estate. So BC residents, homes, and businesses are at the center of our regulated segments. And if a natural hazard event was to happen, all of these regulated segments will be impacted through their own business operations, with homes and businesses and buildings really at the core of it, real estate at the core of it. And in addition, we have exposure also through interaction and relationships that all of these segments have with their clients, with consumers, through services they provide, and advice through the intermediary businesses, and also advice they provide clients. And on the next slide, I want to highlight the physical risks and impact to financial institutions and the pension segment specifically. And their exposure arises through their business activities. So credit unions, as I mentioned before, lend against real estate secured loans and mortgages. And if a natural hazard event happens, the collateral within their lending portfolios might depreciate in value, affecting credit unions and hence posing a risk to their business activities. Insurers will be impacted through insurance claims and through their investment portfolios and pensions through their investments. And that slide is a repetition from before, but really highlighting how the financial institutions and the pension segment are impacted and are exposed to physical risks. Next slide, please. So we have established physical risks as it and defined it on the one hand side. And if we consider climate risk, we have to define transition risks in addition. And transition risks, they arise from a shift to a green economy, to a lower greenhouse gas emission economy. And through policy responses to induce that transition, we define two categories. On the one hand side, there's policy actions that attempt to constrain actions that contribute to adverse effects of climate change, or policy actions that seek to promote adaptation to climate change. And one example we have for BC, for instance, we have a carbon tax that is currently at $65, and that is supposed to increase gradually until 2030. And through policy responses, there is expected mitigation costs and also business restrictions and new opportunities. And through Bill C-12, Canada has committed to net zero carbon emissions in 2050, and that really drives transition risk to the financial services sector. We are already seeing industry restructuring happening, especially in carbon emission intensive sectors like the oil and gas and the farming, construction sectors, to mention a few. And this industry restructuring also leads to changed employment patterns and labor force reskilling. And then in addition, we are observing that already in the market, there is changing investor and consumer sentiment associated with transition risk. So how does that impact investing and lending? Through the transition to a low greenhouse gas emission economy, there is a depreciation of value of certain investment in companies that we are observing and expecting also to happen in the future. There is potential constraints on credit and potential loan delinquencies that can be associated with certain employment sectors being under pressure and leading to higher unemployment in certain sectors potentially in the future. And all this also leads to changes in institutions' strategic direction. So as for physical risk, transition risk really lead to a financial impact. Although they are climate related, they lead to a financial impact. And the time horizon is a bit different to physical risk. When we speak about transition risk, it's definitely longer term. I mean, we see the time horizon is 30 years if we think about being net zero in 2050 as our government committed to. So it's longer term, gradual, but there is the potential for sudden disruption and changes when policy changes and policy requirements are implemented. If we can move to the next slide, please. So we in Canada, we have one of the highest greenhouse gas emissions per capita emissions among the G7 countries. And one driver of these is real estate, is building, the source is buildings, and the other sector, most of our greenhouse gas emissions are driven or derived from is transportation. So how does it link back to real estate? If we look at greenhouse gas emissions arising from buildings, there is, on the one hand side, they arise from building operations, and then we can think along the lines of energy efficiency, the source of energy. Those are linked with greenhouse gas emissions, and also building construction materials. Different materials, have a different carbon footprint associated with them. And to link it back to the segments that we regulate, through all the segments, their own business operations are exposed to transition risks. And then in addition, I want to highlight for financial institutions and pension funds specifically, transition risk arise through their business activities, lending through lending and investment portfolios. Transition risks have to be determined and have to be assessed how they impact and lead to potential financial impact on the business activities. And if we can move to the next slide, please. So then once we have identified and defined, now that we have defined physical and transition risk, we, as financial regulators, we are interested in the impact and the loss quantification and impact on financial services providers, impact to their business activities, and how can we translate that into loss quantification potentially. And the challenge for regulators and the regulated segments and also consumers is really uncertainty about climate change. There's lots around uncertainty. And I mentioned the long-term time horizon. It's about 30 years if we think about transition risk, and usually businesses, financial institutions, they have a time horizon in their financial planning for about 1 year up to 5 years. So 30 years is much longer than financial institutions are used to and are used to operate on. And one key area is definitely data is a challenge that is foundational for companies' sound and prudent risk management to assess climate and earthquake-related risk. And what currently is the status is that there is a lack of current and accessible climate-related hazard models, and often modelers, they focus on one hazard, say flooding, for instance, or earthquake in isolation. But what we need to assess financial impact is really a multi-hazard modeling approach that is required. We need to look at all these risks jointly and together to derive the financial impact. And there is challenges in translating the hazard risk into financial impact. If an earthquake event happens, what is the expected damages, or if a flood event happens, what is the expected damages to physical assets that we can then translate into financial impact, into losses. And one of the challenges is hazard modeling is definitely outside of the financial services sector's expertise, and that provides challenges. And financial models need to link to the hazard modeling, and we have to make sure that they generate outputs that can be used by and that satisfy the needs of the financial modeling required. A big challenge is historical. We have historical and backward-looking data. We have there have been flood events that happened in the past, but they are not necessarily good benchmarks to infer future risks. They might be less accurate for future predictions, as we've seen. Certain risks can be amplified in the future. So there is new modeling models that are needed and required. And so what do financial regulators do at the moment? They require scenario analysis. So that is a common starting point for analyzing climate risk to the economy and to financial systems. It's a tool that can be applied here because possible outcomes are highly uncertain. Outcomes will play out over a medium to longer term. I mentioned the challenges if we have to model 30 years into the future, and through their potential disruptive effects. There's lots of uncertainty and complexity around that. The good news is scenario analysis is a well-established method for developing strategic plans that are robust to a range of plausible future states. The drawback is that it's relatively recent that it gets applied to the climate context and deriving climate risk. And but we have to default back to scenario analysis, given that as I mentioned, with transition risk, lots of the future state is uncertain. So we have to look at potential hothouse scenarios where physical risk events could happen at a much higher frequency, and then also to an orderly or unorderly transition through a net zero carbon emission economy. And the good thing is scenarios are currently established in the financial regulatory world. But as I said, there is lots of uncertainty around that and accessibility to data. So still lots of challenges, but we expect those to, at least over the next years to be addressed, and that more and more models will evolve, more and more credible data will hopefully be created that can be used by the financial sector. And I want to also make one remark about the impact to consumers. Even when climate-related information is available, it may be difficult for consumers to understand how it affects them. And with that, I want to pass it on to Lucas, and he will explain how it links into all this, what was presented to now, links into what BCFSA is proposing as an approach, and on what we are seeking your feedback on. With that, I'll pass it on to Lucas.
Thank you, Francesca. So as Rob and Francesca have articulated, NCCR impacts each of our regulated segments. Now, before I move into how it impacts the regulated segments and the actual pillars of our approach, there's three things I want to emphasize that echo some of the messages in the previous slides, including our mandate, our role in this space, and mirroring Francesca's comments, our reliance on data. So our mandate. As Rob stated, we are not only responsible for both prudential and market conduct supervision, which is different than many other Canadian financial regulators, but we're also unique in that we oversee financial services for real estate throughout the product life cycle. Second, our role. Also stated earlier in the presentation, but just reinforcing. As the financial services regulator, we conduct ongoing surveillance to identify material risks, provide guidance on practices and expectations for managing those risks, and intervene as necessary to ensure safety and soundness and to protect consumers. This work may complement and be complemented by the actions and initiatives of governments, peer provincial and federal regulators, private sector participants, regulated entities, and consumers. And we recognize in our approach the need for a whole of society approach to this broader issue. Finally, and third, our reliance on data. So as Francesca has outlined, data is at the center of a lot of our work, and we recognize the importance of high quality data, not only for us as the regulator, but also for financial services providers and consumers. Therefore, as part of our approach, we will be exploring ways to help ensure financial services providers and consumers have access to data and information needed to determine their NCCR exposures and ultimately to take action based on those exposures. Now, in terms of our data needs as the regulator, we will continue to identify areas where additional reporting may be required, including by working with fellow regulators and standard setting bodies to ensure We measure and monitor pension plans, credit unions, and insurance companies' exposure to NCCR, as well as connections to the work of financial service professionals, and including real estate licensees and mortgage brokers. So with that, those 3 points setting up the rest of the conversation, I now want to take a few minutes to walk you through our approach at a high level, touching on some of the proposed actions and guidance that we've outlined in the discussion paper. So Helena, you could move to the next slide. What we've proposed in the discussion paper is an integrated and proportionate approach to increasing the resilience of the financial services sector and consumers. By that word resilience, we really mean 3 things. First, operational resilience, or the ability to deliver critical operations through a temporary disruption. Here we're really focused on the ability of financial institutions and BCFSA to respond swiftly and efficiently to natural catastrophe. Second, longer-term resilience, or the ability of all financial service providers to understand the impact of NCCR on their strategy and business model, and their ability to respond to plausible but severe climate scenarios. And third, helping to improve consumers' resilience, so recognizing that other part of our mandate. This one is a little bit different, but speaks to both sides of that coin. The emphasis here is on ensuring consumers have access to information, advice, and financial products and services that can help protect them and make good financial decisions. With that context, and you've seen this slide earlier in the presentation as a little preview, we have 2 pillars for our approach. The first pillar focuses on ensuring financial service providers identify, measure, and manage NCCR commensurate with the level of risk to both their business and to consumers. And the second pillar focuses on ensuring financial service providers disclose sufficient information to consumers so that they can understand the products and services they are being offered and have received, as well as understand the exposure of the entities they deal with to climate change and catastrophic risks and how those risks are being managed. You can move to the next slide, Helena. So I'll now spend a little time going over each of the pillars in a little bit more depth, starting with the first pillar, ensuring financial service providers identify, measure, and manage NCCR. Next slide. So at the heart of the first pillar, there's an emphasis for financial service providers to take a step back, review their business model and their overall operations to understand how they and their customers could be impacted by NCCR. Really, for the first pillar, we're focused pretty heavily on financial institutions and pension plans, identifying, measuring, and managing NCCR for both themselves and their customers and consumers. While mortgage brokers, real estate service providers, and real estate developers should also identify and manage NCCR, we emphasize that the actions they take should be commensurate with the risk posed to their customers and clients. For prudentially regulated financial institutions, so our credit unions and BC incorporated insurance companies, will align our expectations with OSFI's B15 Climate Risk Management Guideline, which broadly follows the framework developed by the Task Force on Climate-Related Financial Disclosures, with some modifications based on unique characteristics of BC's regulated financial institutions. So just to pause on the screen here, you'll actually see the framework at the highest level that's been developed and prepared by the TCFD, the Task Force on Climate-Related Financial Disclosures, which really sits at the center of what we're proposing on the financial institution side. What this means in practice is financial institutions will be expected to integrate NCCR into their governance, strategy, and risk management processes and frameworks. A few examples of what this could look like include considering NCCR in business planning and in strategic discussions, having policies and processes in place to identify, measure, and manage NCCR exposures, and as alluded to by Francesca, using climate scenarios to understand the impact of climate-related risk drivers on the business's risk profile, its business strategy, and its business model. What we propose in the discussion paper is capturing these expectations for financial institutions in an NCCR management guideline Likewise, for pension plan administrators, we'll harmonize our prudential expectations with the Canadian Association of Pension Supervisory Authorities, or CAPSA. This means pension plan administrators will be expected to follow CAPSA's forthcoming risk management guideline and incorporate material NCCR into governance, strategy, and risk management processes. And just a note that links to both OSFI's climate risk management guideline and CAPSA's guideline on risk management are available in the chat for your reference. As part of the first pillar, we're also considering the following additional actions to ensure a comprehensive approach to NCCR. First, we are planning on applying an NCCR lens to planned future guidance documents, such as the Residential Mortgage Underwriting Guideline and the Commercial Lending Guideline for credit unions. Second, we are considering strengthening brokerage governance requirements to ensure real estate and mortgage brokers are resilient to NCCR and that they can continue to provide products and services to their customers and clients through potential disruptions. Third, and this is already an ongoing activity, but we'll be monitoring NCCR on a proactive basis and building observations and lessons learned into our prudential supervisory approach. And finally, we will continue to oversee the conduct of financial service providers to ensure they comply with regulatory requirements and fiduciary responsibilities, treat consumers fairly, and provide consumers with the information and advice they need to make informed decisions. If you can move to the next slide, please. So there are a few areas under the first pillar where we do differ from other Canadian regulators. First, as an integrated regulator, we are exploring how best to integrate market conduct expectations into planned and future NCCR guidance, potentially including the NCCR guideline, to ensure financial institutions approach these risks holistically. This would highlight the importance for financial institutions to consider these risks for both their business and to their consumers, as well as considering the changes in consumer needs and preferences, ensuring the fair and inclusive treatment of customers. Second, as Francesca spoke to, we've added earthquake risk to our approach, reflecting the exposure of parts of our province to a tail event earthquake and the potential for damages and disruption at a scale much larger than any climate-related natural catastrophe. Third, we are considering how to adapt the standardized scenarios developed by the Office of the Superintendent of Financial Institutions to the BC context so that they may be used by our prudentially regulated entities. For real estate professionals and mortgage brokers, I'll also highlight here that we are planning on providing education on proactively considering NCCR impacts to their business, as well as education on how licensees and registrants can consider these issues when dealing with clients. If you could move to the next slide, Helena. The second pillar is on ensuring that financial services providers disclose NCCR data and information. Next slide. So there are two types of disclosures covered under the second pillar and outlined in our discussion paper. The first type of disclosure is what we call in the discussion paper market discipline disclosures. So these are disclosures that are intended to improve transparency and allow consumers and investors to understand the exposure of financial service providers to NCCR, as well as the strategies they employ to address those risks. Now, these disclosures are fairly well developed, and what we proposed in our discussion paper is to align our disclosure requirements for financial institutions with the framework developed by the Task Force on Climate-Related Financial Disclosures, which in its broadest strokes requires FIs to publicly disclose their climate risk governance, strategy, risk management, and metrics and targets. This is entirely consistent with the approach taken by the Office of the Superintendent of Financial Institutions, and will continue to monitor and harmonize with where they go on disclosures heading forward, including on timing. The second type of disclosure that you'll find in our discussion paper and that we're exploring is disclosures relating to real estate transactions and consumer awareness. These are a little more leading edge for Canadian financial regulators and is more of a long-term item that I want to spend a little bit more time unpacking on the next slide. Elena, if you could move to the next slide. According to the Canadian Climate Institute, Canadians are unknowingly buying or building homes and other infrastructure in areas of high risk at flooding, wildfires, and other climate change impacts. This finding certainly has resonance in British Columbia, where we've seen several significant extreme weather-related events and considerable extreme weather-related losses over the past several years, as outlined by Rob. Of course, we also have that tail event earthquake risk as part of that equation. While consumers may not be aware of these risks in the first place, they may also experience challenges understanding how available financial products that provide protection from natural catastrophes work, or how they relate to the actual risk profile or exposure to relevant hazards for any given consumer. This may result in consumers, homeowners, property owners, business owners being inadequately protected from financial losses resulting from a climate-related natural catastrophe or for an earthquake. Now, as the financial services regulator, our position is that those financial services providers can correct what we call market information asymmetry by providing expert knowledge on the products they provide and the services they offer, as well as access to information about a consumer's risk profile, both of which may not be readily available or in a format that's understandable for consumers. For real estate customers, this can help ensure they have the information and advice they need to better understand the likelihood and extent to which a flood, a wildfire, or an earthquake could impact the property they are buying and or own, as well as actions they can take to mitigate that risk. Therefore, the proposal in our discussion paper is to explore requiring property-specific NCCR disclosures in relation to real estate. When I use this term property-specific, I really mean going on beyond a disclosure that simply tells someone they're on a floodplain and provides greater resolution respecting their actual situation. From initial developer disclosures for pre-sales of multi-unit dwellings to point-of-sale disclosures to disclosure requirements at property insurance origination and renewal, we will be exploring how regulated entities that provide financial services in each of our segments, including real estate licensees, mortgage brokers, and insurance companies, could effectively disclose and communicate NCCR information to real estate consumers. Now, one promising initiative that I would like to highlight that could support this work is the development of property-level climate risk scores. So, for example, in December 2021, the Insurance Bureau of Canada and the Canada Mortgage and Housing Corporation initiated a project framework aimed at communicating natural hazards and climate risk to homeowners and developing tools to use across the housing, finance, and insurance sectors, leveraging what they call a real estate climate risk index or score to make that actually happen. Now, while BCFSA would not be the one developing such a score, we are currently exploring how such a score, should it be developed, could be leveraged and used to support the work we are doing on disclosures and improving consumer awareness. I do want to emphasize that this piece on consumer awareness disclosures is a longer-term item and that we are considering the associated challenges, including how to promote a common view of risk at the property level so that a potential or existing homeowner or business owner can make informed decisions when purchasing or leasing property, making investments in ongoing property improvements, obtaining financing, or purchasing or renewing property insurance that provides adequate protection against NCCR. With that, I'll now pass it back over to Rob, who's going to summarize what we've went over today before leading us into a short question and answer period. So Helena, if you could go to the next slide.
Thank you, Lucas. So before we do get to questions, I'd like to draw your attention back to BCFSA's discussion paper, which outlines these concepts and approaches that we've discussed today. Next slide, please, Helena. So as mentioned earlier, the discussion paper was intentionally created to initiate an open dialogue and encourage active participation. Our aim was to kickstart a conversation and gather diverse perspectives on the subject at hand. We view this discussion paper as a starting point, and we look forward to building upon it through a collective exchange of ideas and perspectives. In part 5 of the discussion paper, you can find general questions and segment-specific questions on BCFSA's proposed approach. And again, these questions are meant to guide a conversation. They are open-ended and provide a starting point for the dialogue. Next slide, please. A reminder that you're invited to provide feedback on the proposed approach outlined in the discussion paper. We do encourage all of our regulated individuals and entities across all of our segments, as well as interested stakeholders and members of the public to share their perspectives, opinions, and suggestions. There's still time as this closes on November 30th, so please do have your say. And in terms of what else we're planning, we will be increasing our engagement throughout the fall with industry associations as stakeholders, as well as continuing our dialogue with government, different levels of government. And we do look forward to hearing diverse perspectives and questions. So we are encouraging to hear from everyone. Next slide, please. So that is the end of our formal presentation today. We thank you to the speakers, and we do have some time for questions. And there's been a few questions already in the chat. What I'm going to do is ask Lucas to moderate the questions. And Lucas, if we could start with the questions that perhaps we already have answered, but in case people aren't monitoring the chat, let's go over them first. And then we do have one question that we haven't answered. So Lucas, I'll turn it over to you at this time.
Yeah, thank you, Rob. And I will point the first question back at you. It's a few questions that I'll roll into one. Basically, can you expand on how our work supports or complements work done by governments to improve consumer awareness?
So what we're trying to communicate in the paper, said a few times during the presentation today, is that in order to address the causes and risks from climate change, that we need a whole of society approach, and that government has to be part of that discussion. And the question that we've been asked is, what is government doing? And that is a very lengthy answer, and I don't think we can provide everything that government is doing on this file today. Francisca did talk about carbon pricing here in BC as one policy measure. Governments have set legislative targets for meeting carbon emission targets. And government is working on various initiatives that address various aspects of a very complex issue. We need to recognize that public awareness is a shared responsibility between government, regulators, and other actors. And in our discussion paper, what we're putting out there is that at the point of sale or different points of transactions with the public, the financial services sector has a very unique position and ability to be able to help communicate to customers and raise awareness. So that is some of the if you will, the response and the answer, but hopefully we can provide a little bit more of a fulsome response through our answer online.
Thank you, Rob. Francesca, I have a question that I'll direct your way. Are there guidelines or recommendations for credit unions to conduct scenario analysis to assess the potential impact of transition risks on their portfolios?
As Lucas and Rob mentioned, so we don't have any guidelines yet developed for credit unions. But to give you a pointer, Bank of Canada did a study last year with large insurers and large banks, large Canadian insurers and Canadian banks, to assess transition risk to their business activities. And they published the outcome, a report and a detailed technical report that can serve financial institutions as a guide, as guidance to perform transition risk analysis. But I want to highlight as well that, I mean, we acknowledge credit unions are different than large banks, and a lot of the exposure to transition risk for large banks arises and insurers arises from their investment portfolios. So what we encourage all financial institutions to do is assessing, I mean, take a step and take the time to assess where climate and transition risk arise to your business activities, and then take the time to reflect and then prioritize by are you more exposed to physical risk or transition risk, and then prioritize based on your business activities to assess those.
Lucas,
Thanks,
if I could just add add a point about the scenario tests and guidance. I think as there is, and this, I didn't get to the second part, I think, of your question earlier, working with OSFI. When OSFI produces a guideline or guidance, they're very interested in working with the provinces and territories to ensure that there's consistency and that we're not having duplication. And there's a lot of dialogue between OSFI and the provincial regulators through various forums like CCIR, which is the Canadian Council for Insurance Regulators, as well as CUPSA, which is the Credit Union Prudential Supervisory Association. So a lot of these issues are being discussed in dialogue now, how we can avoid duplication and work with especially some of the smaller institutions that we deal with, but ensure that we're seeing consistency across the different jurisdictions. So the question that was posed in the chat about OSFI and what are we doing to ensure that consistency, we're having ongoing dialogue with OSFI to share perspectives, share information, and work towards ensuring that that we aren't providing a whole different set of guidelines at the provincial and national level.
Thank you, Robin. You've actually you've knocked off a few questions in one, but picking up on how this aligns with some of our other work and with some of the work of other regulators through our regulatory association, can you speak to the overlap or how this relates to the work we're doing with CCIR on consumer awareness?
Sure. So CCIR has been looking at climate change, natural catastrophes, and consumer awareness for many years. We have recognized a few issues in that working group, specifically a lack of awareness at the consumer level on the risks that are posed from a changing climate to their personal property and how these risks will change over time. And again, getting back to my comment about in this case, we're looking at insurance companies and insurance agents or intermediaries that are interacting with the consumers or the customer. We are looking at gaps in the awareness for customers, and we're looking at working with industry on best practices or ways that risk can be better communicated and understood by customers and consumers. And a unique, it's not only enough to have to deal with this climate change issue. we're also working in an environment with rapid changes in technology. And we acknowledge that consumers process information differently now than maybe they did in the past. So many things are changing that we're also very cognizant of best efforts being used by industry to communicate those risks, as well as the products that are potentially out there to help, as we say, protect consumers on the insurance side, protect their assets, so that insurance contracts can be, don't want to say easily, but readily understood by consumers before they purchase them and after them. So again, a lot of coordination and work being done at the national level across the provinces, with regulators, with industry to try to find proactive solutions to these very complex issues.
Thanks, Rob. Francesca, question for you, a two-part question of sorts. Do you have suggestions on identifying and foreseeing areas with NCCR risk given the lack of high quality and accessible data? And part two of that question is kind of speaking to some of the ongoing work to improve that data, and whether you think in a close to near term or medium term future we'll have some improved access to high quality information.
Yeah, thanks, Lucas. So I think, yeah, and we spoke lengthy about physical risk, and I think what can be done even today is really trying to identify is, if we take the example of real estate, and is by location to try to identify, is there low, medium, high risk exposure to certain physical events like floods, wildfires, and earthquake. And that can be, it's an important step to identify exposure. If we take the example of credit unions, lending portfolios and the exposure to that risk. And yeah, and we are, as a regulator, we are actively monitoring wildfire activity over the summer, and trying to link that with, I mean, we monitor evacuation alerts and orders and link that to potential exposure for credit unions through their lending activities. So that is one area, even without the lack of these predictive models, and also really the translation into financial impact. And then also with that limited information out there today, scenario analysis can be done in terms of making assumption of, if given high, low, medium exposures, what are potential impact to portfolios. So there is options for scenario analysis that can be done today even. And what have we done today? So Rob alluded to that we have working groups that we are part of. We have a working group together with Bank of Canada and regulators across the provinces that is focusing on flood risk. And there we look at flood risk and their impact to residential lending portfolios of lenders across Canada. And we hope that some of the work can inform and also maybe might be able to close some of the gaps in terms of data availability for flood risk. And then one area I want to point out, lots of the municipalities have good information when it comes to physical risk. And yeah, you can, given that often the business you conduct is very localized, it might be worthwhile reaching out to municipalities and really gain from the knowledge they have, and search that dialogue to assess risk until we expect, yeah, over the years, more and more data will be available and more reliable information will be developed. Back to you, Lucas.
Thanks, Francesca. Rob, back over to you. Obviously, in our paper, we talk both about earthquake risk as well as climate risk, and recognizing that climate risk or climate change represents an evolving and increasingly challenging systemic risk, while earthquake risk is a present-day systemic risk to both the province and the country. How do we as BCFSA propose to manage what the question asker is calling the timing differences between these twin challenges.
Thank you for the question, Alistair. And Alistair from PASIC, very active on the earthquake file on the insurance side. We're very grateful for all the work that he and his organization are leading. The risks that we are identifying here are real. They're significant, systemic. I would say the difference between earthquake and climate risk is we've actually lived through some climate events in the past few years that are really starting to scare people. And fortunately, we haven't had that big earthquake event in a major urban setting that makes people realize how damaging that could be, not only physically, but as that earthquake could potentially spread to the entire financial system. So I think a lot of this, from our perspectives, is really balancing. If I can also say our mandate, we have two mandates: safety and soundness and consumer protection, which includes market conduct and fair treatment. And that's a balance. We always have to look at the balance between the two, between the safety and soundness and the consumer protection, as do financial institutions, financial service providers. We're doing a lot of work behind the scenes to be raising awareness about this issue, both at the government level, both at the company level, at the regulator level, and trying to put our best efforts toward addressing what we think is a very serious potential risk. So in terms of prioritizing, it's a balancing act, but I wouldn't say we have necessarily one ahead of the other. They're both extremely important, and we're working to try to ensure that we are prepared and that those that we regulate are prepared.
Yeah, thank you, Rob. Sticking with you for another question here. This one's a little bit of a process type question in terms of the consultation and engagement over the fall. And I know we spoke to our plans to work through industry associations to continue to gather feedback. But we do have someone asking if we are planning to have specific segment-specific presentations in the future.
We are open to that. Keep in mind that this is a discussion paper. We aren't yet rolling out any specific guidelines, requirements, or anything else. So at this point, we're trying to keep our consultation through the industry associations and allow for the industry associations to organize sessions that they could bring their members to as well. So it wouldn't just be speaking directly with the industry associations, but as well their memberships. And I do recognize that we have a few segments that may not necessarily have that representation from an industry association. So if there's anybody that would really like to have a discussion that feels that there isn't a forum for them to be heard, as soon as you can, just send us a line, and we will we'll look at how we can best accommodate that type of session.
Thank you, Rob. Francesca, back over to you for a question. So there is a question here regarding metrics and targets and whether we have a sense yet as BCFSA of what types of additional data will be necessary to support risk assessment we are doing, and what data would be collected from financial services providers.
So regarding the metrics and targets, so Lucas has alluded to that, and also in the little video that we saw. So at some point, we really need to have exposure information on to physical risk at the building level, at property level. That is something that is required to determine a physical risk. That we need to know how each of the different hazards will lead to losses based on the building. So more information needs to be known on, I mean, location. That is a really by very granular location, by geocoding, and then also to the building type. Building information is really important in terms of building materials, etc. Elevation, all this, and how physical risk impact buildings. So that is something that needs to be developed, loss ratios. So that ties into risk scores that will get developed at some point. And then also more granular emission, carbon emission information on a building level. So there's currently some information out there, but given with the transition to and potential policy that will come forward on building emissions, there needs to be more standardized way developed to assess transition risk arising from properties. And no, so that is one area that is definitely missing. I can't, Lucas, did I forget to answer something? I can't seem to go back to the question.
No, I think you've covered it, Francesca. Rob, question for you. From a private lending perspective, what else could private lenders offer to protect the fund and/or clients besides the necessary earthquake, flood, title insurance, and some of those current information that's already being provided?
So I'm not going to answer this specific question. I think it's a good question. I think what I just wanted to pick up on this question is that, we do want to engage with different segments, because this is a good example of a specific question where I think we could have some dialogue. I think one of the advantages to that dialogue is, trying to understand where we're going to get some of the questions, and we can help as it pertains to two things. One is in future guidance, where we can kind of direct some of our expectations. But two is really, we do have a lot of, either expertise within the BCFSA, or within, our networks to help with, if I can say, some of the education and resources around climate. We recognize that, these are unique risks. And for many, this is their first foray into this area. And with limited resources in many cases, there's just different levels of awareness and education, knowledge about this topic. And I think that's an area that BCFSA can help play a role, and not necessarily providing that education, but working with others to, indicate where there is some resources and education available. So hopefully, that is something that if we find that there's enough interest from the, the conversation, the engagement on this file, that we can direct some resources there. So I think that's all the questions in the chat. Some great questions, and I think just an example of what we're going to continue to see in our continued engagement on this topic. So reminder, the consultation completes at the end of November. We will be reaching out through industry associations to set up some further dialogue. We appreciate all your questions today. If you do have any further questions, require any additional information, or would like to have your say, your reminder, please reach out to engage@bcfsa.ca. So thank you all for your active participation. We wish you a productive remainder of your day. Thank you.